wasn't a couple bars, it was a couple bars, and the third one was especially big. So a lot of traders like me are looking and saying, it could be a blow off top, and in any case, it's a surprisingly good profit, so reasonable to take at least some off. All right, so a reversal, it closed below its midpoint, but it's a bull bar, and we have not had a bear bar in 10 bars. Therefore, it's a low probability short below 30. But because it's kind of a blow off top, it is a blow off top, the market may stop going up for 5 or 10 bars. We may go sideways, maybe sideways for a little bit down for 5 or 10 bars. If we sell off abruptly, not likely, but if we do start to collapse, let's say we quickly go down here in the next bar or two, then we've probably seen the high of the day. If we go sideways and get a double top or a lower high, and we start to get bear bars, then this might be the high of the day. But if we just go sideways until we get closer to the moving average, 10 or 15 bars from now, bulls will probably still be willing to buy. If 31 is an inside bar, then it's a high one and a bull trend. But it's after a buy climax, and after a buy climax, you often get a couple legs of sideways to down. So a lot of the bulls will wait for a couple legs sideways to down before buying again. So 30 is a problem. It's a problem for the bulls. So it's reasonable to get out or to get out partially at the market or below 30 or a point below 30 or below a bear bar if 31 is a bear bar, and then wait for 5 or 10 bars to see what we have. If we go down, then you're not going to be eager to buy. But if we simply drift down a little bit or go sideways, then bulls will buy again. And buying above 31, after that much of a climactic reversal, I'm going to wait. Now, different ways to draw the measured move target. We could use that low and this high. That's one way to do it. Sometimes you do the measured move based upon the bottom of the wedge, which would be there. And that might be part of the reason why we have profit taking here. And then we had another breakout here. We had breakout 24, another one 28. And then we had an attempt at a top here. So some traders would look at that for a measured move. So several different ways to draw the measured move. I'm going to use this one for the time being, but I will switch to that if we go above this one. And the market might be using this and viewing this as a failed breakout above the measured move target. We don't know yet. But this is a stronger breakout, so I'm going to use that. And then the question is, do I use this, the start of the parabolic channel, or do I use this, the bottom of the bull trend? I'll start with this. II and a buy climax, possible high of the day. I would get out of longs here, below 32. And bears, it's a possible high of the day. While they can short, it's more likely that we'll go mostly sideways for about 10 bars. And so bears want higher probability. It's better to wait to see if we get 1 or 2 bear surprise bars or a second sell, maybe a low 2 within a few bars. I received some emails saying that people are not hearing the microphone. I just did a microphone test, and it looks like the microphone is working properly. So I don't know if you have to reboot your computer, but with 3 different people sending me emails saying they're not hearing, I wonder what's going on. I just tried to contact one of the administrators, and I left a message for him to see if he can hear me. All right, so now we have 5 consecutive bear bars. And more importantly, we have 2 bars with lows below the moving average. Remember I said 99.5% chance we would have at least 3 bars with lows below the moving average. And here we have a 3rd bar, 66. The low is below the moving average. I also said that the market will try to get back to the high. but we have 5 consecutive bear bars. It's better to be buying above a bull bar closing near its high. Also, after 5 consecutive bull bars, it's probably better to wait for a high 2 instead of buying a high 1 above 65 or 66. 3 bear bars, high 1, higher probability to buy the high 2. So if you have fairly strong selling, you're probably going to get a second leg down. So it's like a bear surprise. So you wait for a second buy signal, you have higher probability. And you could buy above that. It's a little bull doji, or you can buy above that. Even if we do go to a new high, we're probably not going to go very far up. So the remainder of the day will be quiet. This is what the bears want. They want it to just keep drifting down in an endless pullback. They're hoping that we're doing that. But that's the second test of the moving average. The first test of the moving average, traders bought it. I just got a message that the microphone was back on. Anyway, in case, for those who did not hear what I was saying, up here, I was saying that we have a wedge, 1 pullback, 2 pullback, 3, and a higher high major trend reversal, but we'd probably get a minor reversal. But during bar 60, I said that 99.5%, maybe 99.9% chance that we were going to go sideways to down to the moving average. Normally, we get there by noon or so. So I said that I would not buy around 60. If anything, traders will sell. And I later said that I sold above 43, and I scalped off for 1 point. Now I'm looking to buy, but after 5 bear bars, I would rather buy a high 2, a second attempt to go up, not the first. Are we always in short? We have a bear bar closing below the moving average. I don't think so. The bear bars, even though we have 5 of them, they're not all that big. And we only have 1 close below the moving average, and it's not a big bear bar closing below the moving average. If we have a spike pullback channel, the market often comes down to the start of the channel, 53 low, and then tries to bounce. But because it's a wedge, 1, 2, 3, we should get a second leg sideways to down. So if we do go up above 66, it'll probably form a lower high, and then we'll get a small second leg sideways to down. It's always possible that we can get a major reversal. It's just not likely when we have buying that's this strong. I have several emails from people saying that they're able to hear. So rather than me answering all the emails, I appreciate you letting me know. I didn't really do anything except check. You saw if you were watching the screen, I just checked the microphone settings, and they were working. So I don't know why the sound disappeared, but I'm glad it's back on now. Micro double bottom, down 65, up 66, down 66, up 67, micro double bottom, micro triple bottom. What do I think? Is this the resumption of the bull trend up to a new high? Remember, I was expecting at least a small second leg sideways to down, and 66, 67 qualifies. We tried to go up on 66, we went down on 67, and then up on 67. So it might be enough to get us back up to the high. It's tricky if you do buy right here at the 67 high, because where's your stop? Is it below 67? I probably would use a wide stop somewhere down here. You're not going to let that get hit. But the math is not great here. You're risking 3 points to make 2 or 3 points. So I think it's probably better to use a wider stop to increase your probability. It increases your risk as well, but it's unlikely that we're going to get a major reversal down. Probably the best the bears get is maybe a little bit more down, maybe down to the 30 low, maybe a little bit, the 50 low, maybe a couple ticks below that. It's probably not going to become always in short at any point today. However, after the 5 bear bars, I think it's not going to go straight up. I think we're going to get a test down. Remember, on these extremely strong trend days, the market tends to reach things that look unreachable, and therefore I will not be at all surprised. I would say 40% chance we're going to get up there by the end of the day. To sell below 68, lower high, major trend reversal after a higher high. It's a minor reversal, so I would not sell. The sell was above 43 for a test of the moving average. We've had that test. It's unlikely that we're going to get a bear trend. Usually the market tries to go up to a new high. Some of the bulls will take profits here around the old high, but we might get all the way up there. As I said 40% chance. The higher we go, the probability goes up as well. It becomes 50%. Right now, it might be 50% chance we'll get there. Another attempt at a wedge, 43.60. You can see pretty aggressive profit taking above 60. That's trading range type of trading. It makes a new high and bulls sell, and bears sometimes get aggressive and sell as well. Now, can you sell below 69, a wedge? With those two good bull bars, 67, 68, it lowers the probability. This happens all the time when you get a reversal and you're deciding, is the reversal bar the start of a trend reversal, or is it still simply a pullback in a bull trend? So is 69 a pullback from 67, 68, or is it the high of the day and the start of a bear trend? 67, 68 both are strong, plus the bull trend is strong. And therefore, even if 69 is a big bear bar, I still think it'll be a minor reversal. I think of it more as a pullback than as a trend reversal. If we have a conspicuous tail on the bottom of 69, a 3-tick tail, that would further lower the probability that we'll go down. If it closes on its low, you'll get some bears willing to take the short. But I gave you many examples of small pullback bull trends where the market did not touch the moving average until late in the day. And how many of them had a significant reversal at the end of the day? Okay? No significant reversal here, none there. Here, yes. Okay, that's one. Okay, no. Okay, drift downward, but not a really big reversal. Here, the pullback to the moving average was severe, but then we went up from there. So, what do you think? What are the chances of the market getting a big reversal? I'm showing you lots of examples of strong bull trend days, and how many of them are getting big reversals in the final hour, right? Basically zero. So we're not going to get a big reversal. The question is, are we going to pretty much stay sideways, or are we going to try to get up to that measured move? And at this point, I don't know, it might be back to 40% chance that we'll get up there. Bulls, I'd get out either below 69 or maybe a point below 69. And for the bears, I would not short. Some bears sold the 60 high and they scalped out. It had to fall 5 ticks for them to make 1 point, and it fell 7 ticks. So they were able to make 1 point. I rarely ever talk about forex markets, but today I did buy the euro right after the report. A relatively weak sell-off and a lower low, and a lot of trading range trading here. So I thought we'll bounce. So I'm expecting some kind of a bounce. We still might get all the way down here, but to me this looks like a big bear surprise. Second leg down, not strong, and pretty neutral in here. So I think we'll probably try to bounce a little bit. You can also argue a wedge channel with that low, this low, this low. The bulls high one. We're in a weaker bull trend now. We had a small pullback bull trend for about 25 bars, and then a very strong bull breakout. And now we're in a bull channel, higher lows, higher highs. So it's a weaker bull trend. The bulls are hoping that we get this again and go up to that measured move. So math is not ideal. You're buying at the top of a bull channel. You're buying at the top of a trading range, but it's still a small pullback bull trend and 50% chance we go here. So if you buy above 70, stop maybe a point below 69. So you're risking about 3 points to make maybe 5 points on, maybe a 50-50 bet, maybe a little bit less than 50-50. So it's marginally good buying. Can you sell below 70, 71? Micro double top, up 69, down 69, up 70, down 71. A wedge, 43, 60. I would not sell. Certainly not below a bull bar. There's still plenty of time left in the day, and the market could get there with 2 or 3 good-sized bars. Unusually strong bull trend day, but bear bar and bear bar 69. This is good for the bulls because they can tighten their stop. So instead of below 69, if they buy here, they can put their stop maybe a couple ticks below the II 70. But one of the things about small risk with good reward means fantastic risk reward. And that automatically tells you the probability is low. Whenever your risk is small, your probability is low. If you pay $1 for a lottery ticket, the most you lose is $1, and your reward is $1 million. So your risk reward is fantastic, and that always tells you that the probability is low. And here, if you put a stop below 70, your risk is small. Compared to the whole day, it's just a tiny piece of the day. And the smaller your risk, the less likely you'll make money. So, this is not a great buy. If you think about it, let's say you bought at any point today during this really strong bull trend and you used a 1-tick stop. So you buy, you get filled, and you put a stop 1 tick below. So the most you're risking is 1 tick, right? You would have been stopped out here. It pulled back more than 1 tick. You would have been stopped out there. So even though the reward was very big, the risk was so small that the probability of your stop not getting hit was too small. So you have to use a stop that is appropriate. And if a stop is too small, it's going to get hit. And the argument is, well, at least I did not lose much. But if that's your style of trading and you do it 10 times a day, you've lost 10 times the small amount. And 10 times the small amount becomes a big amount. It's bad, so it's bad to be using stops that are too tight. It's equally bad to use stops that are too big. So for example, if I buy right here, and the market's at 4,000, and I put a stop below 1,000, right, what are the chances that I make money? Like 99.9999%, right? But the stop is so far below that it's meaningless. The market's not going to go below 1,000. So effectively, you do not have a stop. But if you have an extremely wide stop, which is basically no stop, your risk is very, very big. The probability of making money, especially if you're just looking for a small amount of money, a point or two, the probability of making money is virtually 100%. I'm as close to 100% certain as I can be that even though this is the all-time high, we're going to be higher, a point or two higher at some point in the next 30 years. So you can risk 3,000 points to make 1 point, and you have basically 100% chance of making money. Remember, the bulls were hoping that we go up here, and if they decide we're not going to make it, they're going to sell out of their longs. And that's what this hesitation is, 69, 71, 73. Now, what about selling below 73? Do you see a problem with that? It's a wedge rally, 43.60. It's a double top, 69, but it's also in a 9-bar bull microchannel since bar 65, and that lowers the probability for bears selling below 73. Just like it's not a strong buy above 70 or the II 71 or the bull bar 72, it's not a very high probability sell below 73. I am currently flat, and I suspect I'm not going to take any more trades. We have 6 sideways bars. I think the bulls probably are not going to be able to get up there. We're spending too much time, and we're not getting the breakout. And therefore, the bulls who bought through here expecting this are going to sell out of their longs. And that's what they're doing here. But how far down will it go before other bulls buy again? I think it probably will not get far down. The bears, they're not selling 73 for a scalp. You know, it's a 10-bar bull microchannel. The probability is it's a minor reversal. So if you're taking a sell that's probably minor, that means the chance of it being major, the chance of making significant money is small. So the bears selling, they need a very big reward to offset their small chance of earning that reward. So whenever the probability is low, you have to swing trade. You have to take a chance that you get a big profit. Consecutive outside bars, bulls again trying to get up to that measured move target. It's very often when you get these reach moves at the end of the day, it's just like 3 or 4 bars. You suddenly get 3 or 4 bars at the end of the day, and then the market is at the target that looked far. So now it again looks like a 50-50 bet that we'll get there. Remember I said the bulls have bought above 71 or 72. It's probably better to use a wide stop because the risk was too small. Not very far. And I don't know that that's the target, but it certainly looks like it. We had an attempt at a top here at 30, and then an extremely strong breakout. And therefore you have to be wondering, is the market going to go for a measured move up? And that's right there. There might be other targets as well. For example, I did not look. There might be a Globex target. So Globex low and Globex high. Well, we're beyond that. And 60-minute chart. You know, we're already beyond the measured move up from this gap. Really unusual to get that many bars, that many bull bars, and then here, no pullback to the moving average. And right now, 70 or 69 bars. Really unusual. Traders will buy the first pullback to the moving average, but we're extremely overbought. Okay, so there, right at the target. You can see I went one tick above and pulled back. Why? Because a lot of bulls place limit orders to get out at the measured move. End of the day, end of the week, 3-day weekend. On the weekly chart, we have the top of a channel up there. So that's a magnet. And then the pandemic sell-off last year, instead of going down, we're going up. So a measured move up there is also a target. That's about 4,500. I mentioned that gap on the 60-minute chart here. We're right around a measured move now from that. And all of these things that I'm showing are minor resistance. The market's not going to turn around and form a bear trend. But you might get some profit taking